Transmitting to you live from the Queen City, streaming to the world and beyond. This is the Traders Vibe Video Podcast Show. We talk and you listen. And now, here's your host, Carl Burgett, aka Chaos Trader.
Today's guest on the Traders Vibe Video Podcast Show is Mr. Al Brooks. Al has been trading for over 30 years, and he is a self-taught price action trader. You can visit Al's website, brookstradingcourse.com, as you see here, and he has a lot of content that you might be interested in, such as his trading course, a trading room, his trading books, as you can see, and things about his price action trading. And you can also go to his other site, which is brookspriceaction.com, which you see on the page right here. And there's more information there also. So you also can see that he has his trading books and the forum, the blog, trading room, trading course. So if you're interested in any content that you see today, visit either brookstradingcourse.com and brookspriceaction.com. All right, so let's get right to this session. All right, traders, welcome to the Traders Vibe Video Podcast Show. My name is Carl Burgett, aka Chaos Trader 63. Every week, I am bringing you some of the most prominent traders in the business. And today, I want to bring to you Mr. Al Brooks. Al is a technical analyst, contributor to investing.com, the MoneyShow, and he has taught advanced day trading techniques at the Chicago Mercantile Exchange. Al also is an author, and his book, Reading Price Charts Bar by Bar, which is a great book and I already know about it, was a bestseller for Wiley in 2009. In 2012, Wiley published Al's comprehensive 3-volume price action series called Price Action Trading Trends, Price Action Trading Ranges, and Price Action Trading Reversals. Al has lectured on 4 continents and taught tens of thousands of people around the world. And now today, Al is here with us to help let us understand a little bit more about how he trades. Welcome to the show, Al.
Thank you very much, Carl. I appreciate your allowing me to speak to your guests.
I'm pleased to have you on the show because I know a lot about you. When I studied price action, you were one of the main people that I was looking at, and also your books and stuff. So it's great to have you on the show.
Thank you.
So first, Al, give us a little background about yourself. Tell us who you are. Tell us about your how you got started trading.
Well, I grew up in a relatively poor environment, and I ended up going to medical school at the University of Chicago because my mother wanted to have a doctor in the family, and so I became the doctor. But the entire time that I was there at the University of Chicago, I kept thinking I really belonged at the Mercantile Exchange or the Board of Trade downtown, and I just felt like I was in the wrong career. I practiced medicine for about 10 years, and toward the end of that time, I started day trading. And back then, there were no E-minis, and there was no Forex. And I used to trade the S&P 500 futures. I started trading aggressively in October of 1987, the beginning of October 1987. And there was one day, a Monday in October, and I thought the market was going to go down big. I was heavily short, and I had a full surgery schedule. So I had to close out my position right at the start of the day. And as I was driving into work, I was listening to the news, and they were saying the stock market is crashing, the stock market's going down, nobody knows how far down it's going, and it's just dropping like it's never dropped before. At the end of the day, the market was down, depending on which exchange, about 25%, 24%. And had I kept my positions instead of going to the office, I would have theoretically, if I exited on the close, I would have made $400,000 in one day.
Oh, man.
And that was the day that I decided I could probably do this. And so I started figuring out how to stop being a doctor and how to transition over into becoming a trader. Over the next 3 years, I had a daughter in 1988. And 15 months later, I had identical twin daughters. So I had 3 daughters under the age of 15 months.
Wow, that's nice.
Yeah, it was cool. And I decided that, maybe I should start working in the office less and start working at home more. And I started day trading. Back then, the world was filled with incredibly dishonest people. You'd sign up for courses and the ads that were run they're just outright lies. And back then, I assumed everybody was honest. I couldn't imagine that anyone would be dishonest. And I signed up for all these courses. I had tutors, and I was losing money, and I kept losing money. And for about 10 years, I was losing money. I had a lot of money saved up from practicing medicine for 10 years, but it was really frustrating because in medical school, you learn that if you study hard, eventually you learn how to do what you're supposed to be doing. Right. And here I am reading everybody's stuff and hiring all these people, and it wasn't working. And I concluded that it was all a bunch of garbage and that the world was filled with crooks and the government wasn't doing anything to stop it. The NFA now stops it. So people who have been trading for the past 10 or 15 years, they don't have all the nonsense that was present back in the 80s. And what I did was I just decided that when I look at any chart, I can see, it's going up, I got to buy. It's going down, I got to sell. And I got rid of all my indicators, and I just started looking at chart patterns. And I started to discover that I could trade profitably just looking at the bars on the chart and getting rid of all the indicators, and also only looking at one chart. So if I print out a chart at the end of the day, it's pretty easy to find reasonable trades on that chart. What I decided that I had to do was learn how to do that real time on my own. So I started developing patterns, the ability to recognize patterns, and then the ability to place trades and manage trades. And it's been very good to me ever since then. But it took a long time to figure it out.
Well, that's great, Al. So you basically, there's still a lot of crooks in the world still. We have that same stuff going on all over the place. You could find that still, but you basically are self-taught then with what you do, right?
Absolutely, totally self-taught.
Okay.
And because it was so difficult to find someone honest, I want to be that guy. That's why I'd make more money if I didn't spend time in the chat room and if I didn't do all the typing that I do at the end of the day, before the day. But I like doing it. It's enjoyable. And at some point you have enough money. I could retire now. I'm 68 years old. I could retire now. I could retire pretty comfortably right now. But I like what I'm doing, and I also like getting better and better and better at what I'm doing. And I also like sharing what I'm doing. And I feel like I'm doing something nice. I feel like I'm helping people. And it makes me
contributing to people.
Yeah. Now that my girls are all gone, I want to feel like I have that I'm doing something significant and that my life has meaning. And this makes me feel good.
I understand that. So since you're self-taught, how long did it take you to basically start becoming profitable? Because you said you were losing for the first 10 years and you were doing other people's stuff. So when you started doing your own thing, how long did it take you to really put it together, Al, where you understood what you were doing and were able to start being successful?
It took me 10 years. It took me
more years.
Yeah, it took me that first 10 years.
Oh, okay.
That first 10 years, initially I started by reading books, reading magazines, going to meetings, and hiring tutors. And I did that for a number of years, 5 years or so. Okay. And then I decided that I was losing money. But when I look at a chart, it looks like it's pretty easy to make money. So I decided to strip everything out and just start to build around 5 years in, early 90s. And it took me about 5 years to really feel like I had a very good understanding of what I was doing.
That's fantastic, because what's really amazing is that you were able to take everything off of a chart and then just start looking at the price and the candles and then start putting your own synopsis to the market, which is something that's fantastic. Hard to do too.
Yeah, but it's interesting. You know, I view the chart as just a reflection of human behavior. And, you know, I view all charts, all timeframes, all markets as pretty much the same. They're all just a manifestation of rational human behavior. They just map out trading, you know, no different from people bartering 5,000 years ago. It's the same process, and it's all rational. And the patterns tend to repeat. I mean, they have to repeat because there are only so many rational ways to behave, and a chart is just a mapping of rational human behavior. So what I do now, and I'm pretty good at it right now, is I can read what's going on. I can see what's going on. I trade mostly the E-mini. I do trade the Forex markets. I trade bonds. I trade crude oil. But all day long, I'm pretty much glued to a 5-minute E-mini chart.
Okay.
And I've watched every tick in the stock market, just about every tick in the stock market, for about 35 years now. And I probably have seen more ticks and more charts than anybody else on the planet.
Yeah. So since you're talking about sitting there looking at your charts, 5-minute charts and so forth, tell us what your daily routine consists of. What do you do when you first get up? What do you start your routine with? How you get going?
Now, I first look at the markets. First thing I look at usually is the euro versus the dollar Forex market. And then I look at bonds, I look at gold, I look at crude oil, look at a bunch of stocks, and then I move over and look at the stock market, the E-mini. And I have a bunch of charts marked up, and I add to the markings and I erase other markings every day as new information comes in. And I come into the day with a sense of what I think is likely. When I'm day trading, I'm looking at mostly 5-minute charts. I do hold overnight positions. Sometimes I'll hold positions for several days or a week. But as a trader, you know, I trade. I'm in and out. So if I'm trading the E-mini on an average day, a slow day I might take 10 trades. A busy day I'll take 20 trades. And when I was your age, sometimes I'd take 30 or 40 trades in a day.
Believe it or not, we're pretty close to the same age. So, but anyway, yeah, that's good to hear. So basically tell us, taking that many trades, like when I first started trading, I found that I trade the daily time frame now, because when I first started trading, and I also think that to be trading those lower time frames, you really have to be a good trader because things happen quickly. So you have to be able to see things. But taking all those trades, then how do you manage your risk? What do you do to control risk? Because you're in the markets a lot.
Yeah, I have a bunch of rules that I use, and there are certain types of markets that I really enjoy trading. And there are other types of markets where I do not enjoy trading. And when the markets are trending or having big swings, I trade very actively. And if the market's in an extremely tight trading range, I trade much less actively or not at all. In general, I think everybody should be entering with stop orders, especially if they're a day trader. I think they should be entering with stop orders. And whenever I take a trade, the first thing I look at is, where's my risk? Where do I put my stop?
Yeah.
And then I look at how much reward is realistic. And in general, if I'm looking for a swing trade, as a day trader, a swing trade is 30 minutes to an hour, maybe a couple hours. If I'm looking at a swing trade, I will not take the trade unless I feel like it's reasonable to expect a reward that is at least twice my risk.
Okay.
And when I take scalps, I do scalp a lot because most of the time there are a lot of scalps and not much swing trading. When I do scalp, the reward is always going to be less than the risk. And if you think about that, so let's say you're trying to make $1, but you have to risk $2, right? There's a third variable that no one ever talks about. Everybody talks about risk and reward, but you always have to be thinking about probability, because if you have a risk that is greater than your reward, you have to win a high percentage of the time. So let's say in the E-mini, let's say Forex market, let's say you're trying to make 10 pips and you have to risk 20 pips. If you are right 67% of the time and trade perfectly, you break even. And the purpose of trading is not to break even. The purpose of trading is to make a living,
Right.
also to have fun. So you have to be right a lot more than 60% of the time if you're risking 20 pips to make 10 pips. And you probably have to be right 80 or 90% of the time. And most traders, that's just unrealistic. So most traders cannot scalp for 10 or 20 pips. They cannot scalp for a living. They have to be going for more profits than 10 pips on a trade, especially if they're risking 20 pips.
Yeah, because they're getting greedy, basically.
The problem is the probability. People don't understand the probability. A lot of times people look at a chart and think, oh, gosh, that's a really high probability trade. But it's never as high as you think, because the markets are all institutions. We're just, we're breadcrumbs. We're 5% of the market. 95% of all trading is institutional. And there has to be a reason for them to take the opposite side of our trade. I always assume every trade I take, an institution is taking the opposite side of the trade. So if I'm buying, the institution thinks he can make money selling. So my probability can't be as high as I really want it to be. And my default is I always assume probability is about 50-50. Sometimes probability is as high as 60% for a trade. Rarely it's less than 40%. And if you go for a reward that is twice your risk, even if you're right only 40% of the time, you're going to make money. So as a rule of thumb, always go for a reward that's at least twice your risk. If you can get 3 times, that's better.
Okay.
But if you are going for a reward that's twice your risk, you don't have to be thinking about probability, because 90% of the time, probability is between 40 and 60%. And in that window, you're going to make money if you're always going for a reward twice your risk.
Very interesting. So talking about the risk, one more thing about risk, when you're in a trade or when you open trades, do you think about risk percentage as far as capital and stuff?
When you trade a long time, you tend to have a whole bunch of accounts and a whole bunch of brokers. And one of the reasons, so I have a whole bunch of accounts and I have a whole bunch of brokers.
Yeah.
And money's fungible, right? So you can take money from one account and put it into another account. So I never think in terms of percentages, because, is it a percentage of the account that I'm trading? Is it a percentage of my total trading accounts on all my different accounts? So for me, it's different from someone starting out. Someone starting out has one account, $1,000, $10,000, and percentages become really important.
Right.
If a person's starting out, they should never risk more than 2 or 3% on any trade. With Forex markets, that's possible because you can trade 10,000 units or 1,000 units, right? 1,000 units. That was not always the case. Back when I started trading in the 1980s, for example, if you trade the S&P 500 contract, there was one contract, and it was a big contract. It was 5 times bigger than an E-mini. And if you have a small account, you always are risking more than what you should be risking. There's a concept called risk of ruin. And if a person, that's always present. Even today, I have a risk of ruin. It's possible that even with a very small percentage of my account trading, that I could lose 1,000 times in a row and I could go bankrupt. So it's, realistically, it's not going to happen, but you have to be aware of that concept. And because of that concept, if you start to risk more than 3% of your trading account, especially if you're really not a very good trader, you're going to get ruined. You're going to blow your account.
Yeah.
So I think one of the problems that a lot of traders have when they start out is they think they're trading small, but they're actually trading big. And if you do the math and you look at where the stop has to be, and you think, oh, I'm risking 2%, 3%. Realistically, you're probably trading much bigger than you should be trading. When someone's starting out, they should trade the absolute smallest position size that they possibly can trade. And I know the argument, Al, if I trade 1,000 units or if I trade one E-mini contract, I can't make a living. That's right, but you also can't go broke.
Right.
And when you're starting out, it's much better to work on becoming consistently profitable, even if you're making $1 or $10, than it is trying to become a superstar. And if you do it for 6 months or a year, you can, instead of trading 10,000 units, you trade 20,000 units. And it's a process. It takes a few years. You're not going to get rich fast, but after a few years of trading small, all of a sudden your account starts to get bigger. If you get pretty good at it, you can make 100%, 200% a year of your account size. So if you have a $5,000 account and you're consistently making 1% a day, just 1% a day, at the end of the year, you'll have a $10,000 account. And next year, if you trade 20,000 units and you stick to trading small and you make 1% a day, you'll have a $20,000 account. And then all of a sudden you can start thinking about, maybe I should trade 100,000 units. So after a few years of working your way up, you would not have lost significant money, and you would have developed the skills that would allow you to make a living as a trader. So it's really important, I think, to start small and work on consistency. Baseball analogy, just try to hit a bunch of singles and don't worry about getting rich. Don't worry about lottery tickets. Just consistently try to be profitable. That's the single most important thing, I think, as a trader.
Yeah, and I think that's hard for most people, right? The first thing they think about is the profits and how quick they can get rich or whatever and so forth. And they're not thinking about the consistency, the patience, the discipline, none of that stuff. So psychology is a main part of trading. But can you tell us basically about your trading style? What's your main trading concept? Take us to the charts and just explain to us whatever you want to explain to us.
I look for patterns. Let me see if I can show. Are you able to see this chart?
Yes, sir.
Okay, that's a weekly chart of the euro versus the dollar. And right here, I have a 10-bar exponential moving average, but I really don't pay much attention to the moving averages. Let me just take that off. I'm mostly interested in bars and patterns, and I'm always looking for things. There are a whole bunch of patterns that I look at. For example, we have a very big reversal up here, and then this bar, the high did not go above that bar, the low did not go below that bar. Going sideways, we got a pullback. I'm looking to buy that. Let's just talk about right here. Let me do this. Okay, this is the weekly euro versus the dollar, and we had a big rally here, and then we sold off in a bear channel for a couple of years. We had a very big reversal down, a pullback, and then a channel. And I refer to that as a spike and channel bear trend. Eventually, you're going to get a bull breakout of a bear channel. If you have a bear channel, 75% of the time, you're going to get a bull breakout of a bear channel. So every bear channel is a bull flag. Every bull channel is a bear flag. So I know you're going to get a breakout above the bull channel. 75% chance you'll get a bear breakout below a bear channel, and then you start the process over again, spike and channel down. But 75% of the time, you have to expect a bull breakout above a bull channel. And I talked about this as a spike and then a channel. That first pullback where the channel begins is a magnet. So once you do break above the bear channel, you have to assume the market is going to get up there and test that spike. And when we were down here in my chat room and in my blog, I was talking about how this was the target, the June 2018 high. And that once we got there, the market would start to form a trading range, because typically with a spike pullback channel pattern, you go up to the start of the channel here and you stall and then you go sideways. So as strong as the rally has been for the past several months in the euro versus the dollar, it's more likely that we're going to pull back and go sideways than it is that we're going back up to the February 2018 high. And another pattern that I look at a lot is wedges. The market's constantly forming wedges. And a wedge is just a channel that has 3 points in it. And sometimes it's very tight like this. When it is, I call it a parabolic wedge. And what you often see is a wedge pattern where the wedge rally comes up to a prior top and you get a wedge double top. That is another pattern that I know from experience typically results in a reversal. So as strong as this rally has been, I think we're going to pull back to the breakout points here and here. That would be a 500 pip pullback over the next couple of months. And then other things I look at streaks. Now, what do you notice about this rally? You say, wow, that's pretty strong. Well, let me tell you something else about that rally. We have a bull bar here, a bull bar here. In fact, we have 9 consecutive bull bars. How often do you think you see 9 consecutive bull bars on a weekly euro chart?
Not often.
Okay, the last time was 2004. Okay, so what does that tell you? It tells you that anytime you start to get a bunch of consecutive bull bars, it's unsustainable, then it's a buy climax. So that's another way to view this as a buy climax test of resistance. So what do I expect? I expect a bear bar. But more than that, if you have a streak of a lot of consecutive bars, usually you come down and pretty much erase all of those bars. So as strong as this is, at a minimum, I think we'll pull back to this March high or the June high, and we may pull back to the beginning of this 9 consecutive bull bar streak. And there's a similar thing going on in the E-mini as well. On the excuse me, on the daily chart, we have a streak going on, and that's probably going to result in a 200-point pullback in the E-mini sometime soon. You can go higher, right? Typically, when you have a streak, 7, 8, 9 bars, and you get a bear bar, people typically buy the first bear bar. So usually the first bear bar, they buy it, and you go up 1 or 2 more bars, and then the pullback begins. But as strong as this is, I think we're going to get a 500 pip correction starting sometime in the next month or two. So those are the kinds of things. Spike in channel, I expect a bull breakout of the channel, testing the start of the channel. Wedges, it's a type of channel. A bull channel is a bear flag, so I expect a bear breakout. A wedge rally, typically it's a buy climax. It'll attract profit taking. The stop for these bulls, if you're buying up here, is your stop here? No, if you're buying up here, your stop is down here. And the risk is big. And if you're an institutional trader, the risk manager, your boss, is going to come by and tap you on the shoulder and say, your position's too big. Your position was fine when you were down here and your risk was here, but now you're risking all that. You can't do that. You got to lower your risk. Easiest way to lower your risk is reduce your position size. So there's an incentive for bulls to take profits. The boss is going to be telling you, you can't risk that much. You have to reduce your position size. So bulls are going to start taking profits.
Interesting.
So there are a whole bunch of little things like that I'm looking at all day long. And, I have hundreds of little things like that. And I see them all the time. And I get practice with them all the time. And I'm very good at recognizing them. And I'm also very good at anticipating them. And I think that's a very important thing as a trader. If you can start to see what the market might be trying to do, then you will not be surprised when it actually does what you think it might do. And you can be in position to capitalize from it.
So practicing all that, how do you do that? How do you practice your price action trading of looking at charts like that? Do you do it? Are you practicing during the market or after the market? And how do you go about practicing?
Well, one thing, this is a chart that I use all the time, right? I mark it up every day. I put new prices and I put new lines. And, I've got the daily and weekly and monthly charts of it. Here's the monthly chart. Now, here's something interesting. This is the monthly chart. Let me get rid of some of these lines. Moving average sign. Okay. Okay. Monthly chart, we have a big bar. The close of this bar is above the high of that bar. The close of this bar is above the high of that bar. So this bar is breaking out. It's breaking out above the high of the prior bar. It's breaking out above that. And it broke out above this as well. And whenever you have a breakout bar, what becomes really important is the next bar, right? This is the current month, August. This is a monthly chart. August is a really important bar. And if it's a bull bar, for example, we have a breakout here, and if it's a bull bar, we're probably going higher. We have a breakout here, but if it's a bear bar, then we may start to correct down. So the body of August is going to be very important. if it's even a small bear body, it increases the chances that we'll test down. Remember on the weekly chart, I said we're probably going to test down. And whenever you have a breakout, if the breakout fails, the first target is the bottom of the breakout bar, which is the bottom of this bar. And that also corresponds to the bottom of that 9-week streak on the that I showed you on the weekly chart. So that's another pattern. A breakout, you want follow through. You want a good follow through bar. Here we got a bear breakout, close of this bar below that bar, and good follow through, probably going lower. Another breakout bar, a bigger bar, a bear bar follow through, we're probably going lower. A bear breakout here, but a bull bar, we're probably not going lower. So the follow through here, we got a big bear breakout. We have a bear bar here, but it has a big tail on the bottom, which is not good if you're a bear. You don't want to see it go below a prior low and have a big tail on the bottom. And then the next bar is a big bull bar, reversing it. So when I see that, I'm looking to buy around the close of that bar or above the high of this bull bar, betting that this bear breakout will fail. Big bull breakout here, close above that bar, close above that bar, and then a bear bar. So I'm thinking, it might fail. Also, 3 legs up, 1, 2, pause, 3. So this is a type of a wedge. I look to the left, it's also a lower high double top. So a wedge rally to a double top, that usually leads to a reversal. Here we got a wedge sell-off, 3 legs down, 1, pause, 2, pause, 3, couple micro double bottom here. So a wedge bottom and it's a double bottom, that usually leads to a reversal up. So I'm looking to buy above that bull bar for a swing up. And I do this on all time frames, all markets, and this is what I do for a living. And every day I mark up my charts and I update the charts. In my chat room, I have lines drawn over the charts. And that's what I do. I just look for chart patterns and I look for where the stop has to be. And I look to see if there's enough room, if I'm buying, if there's enough room to resistance for me to make a reasonable profit. And I'm also very good at getting out of bad trades. Sometimes I do stupid things. And if I do something stupid, I don't look at it and say, oh, maybe it'll go my way and maybe I'll be smart. If I do something stupid, I just get out.
Yeah.
And, so I lose 10 pips or 20 pips. But if I should not be in this trade, I got to get out of the trade. And I don't care if I lose money, because if I don't get out of the trade, I'm probably going to lose a lot more money.
Yeah.
So as soon as I go into a trade, even if I go into a trade and it makes sense at the time that I take the trade, but then it does something that is disappointing, I got to get out of the trade. If it's no longer doing what I thought it was going to do, then I got to get out of the trade. And so I pay a lot of attention to disappointment bars. For example, let's just look at the daily chart here. So let's say you're buying above every bull bar closing near its high, and then you get this. Okay, so let's say you bought the close of this bar or above this bar. Okay, this is a daily chart, and then you get that. All right, you're disappointed. So if you're a trader who bought that close and you see a disappointment bar, you're probably thinking, oh, that's not what I wanted. I wanted another bull bar and I got a bear bar. So I better try to get out break even. So a lot of the bulls who bought that close, once they see that, will try to get out break even. And the result often is some kind of a double top. Here we got a slightly higher high double top because these bulls are disappointed bulls and they're disappointed they want to get out. And that's a very common type of reversal here. Just a bear who sold that close hoping for lower prices. He was probably disappointed by the Stoji bar. He certainly was disappointed by a bull body, and the bears bought back the shorts. Every reversal up from a low begins with disappointed bears buying back shorts. And every reversal down from a high begins with disappointed bulls selling out of their longs.
That's very interesting.
Yeah, let me say one other thing. A lot of traders put up all these indicators on their charts, and it's like, oh, I'm a smart guy, and Albert Einstein probably would have all kinds of lines on the chart and, you know, all kinds of indicators on the chart. And, you know, maybe Albert Einstein would be a great trader. Well, you know what? I bet Forrest Gump would be a better trader than Albert Einstein. You know, Forrest Gump would look at the chart and say, oh, it's going up. I got to buy. Well, what about all those indicators showing divergence? You know, I don't know about that. But it's going up. I got to buy.
Yeah.
You know, it's going down. I got to sell. What about those indicators saying it's oversold? I don't care. It's going down. I got to sell. Right. So, you know, I think being smart is always nice. You know, it's good. You can make intelligent conversation at parties. But as a trader, you don't have to be a super smart guy. You know, you have to be an average smart guy who has good skills and good psychology, good management. Another thing about traders, I think most traders starting out, if you've been trading even for just a few months, you look at your list of winners and losers and you say, oh, that's a good trade. Oh, that's a bad trade. I shouldn't have taken that one. All right. And if you look at the list, maybe you won 30% of the time starting out. Well, those 30% of the trades that you took that were good were probably really good trades, right? And the reason you lost money was because 70% of the trades you shouldn't have taken, right? So your objective starting out is not to take more and more trades, is to stop taking stupid trades. If you can get rid of those stupid trades, all of a sudden, you're going to find out that you're starting to make some money.
Right.
So I think it's really important. And if you make mistakes, don't stay in hoping that eventually it's going to go your way. You know, just get out quickly. Don't wait for a stop to get hit. If the trade is not doing what you think it should be doing, just get out and then look for the next trade.
Very good. I like that concept. Basically, that's what you should do. But a lot of people have a hard time doing that too. So that's, again, part of the trading psychology where we're having issues, where most people have that issue. Some people are asking me some things, and I just want to ask some of the things that they want to know. So someone's asking me, does this work with stocks also? Because I guess they see the Euro chart up there. So they want to know, do you trade stocks, and does it work the same with stocks also?
Yeah, it does. You know, as I said, there's a TV show called Fast Money.
Yeah.
It's CNBC. A lot of people watch Fast Money. And when the traders are on, sometimes they'll talk about gold, crude oil, sometimes stocks, sometimes different time frames. They don't say, oh, this is Apple, and I got to trade it differently from crude oil. Oh, and this is gold. You know, I got to trade that differently. You know, all trading is rational human behavior, and it's institutional, right? It's rational, it's logical. And, you know, excuse me, I'm losing my voice. And, you know, I trade every market the same, every time frame the same. In fact, when I print out charts at the end of the day, I don't even show the price or time, I just show the bars. And the reason for that is because it doesn't matter what the time frame is, it doesn't matter what the price is. What matters is the patterns. You're looking at the buyers and sellers, you know, trading between one another, and they're going to do the same thing for any market and any time frame. So, you know, and that's how I trade. You know, I don't pay attention. Oh, this is a 5-minute chart, or that's a monthly chart. I'm going to trade them all the same. They're all mapping out rational human behavior. It's in our genes, and until we evolve into some other species, this is what is rational for us. And you know, that's, you know, so I trade everything. I trade every market the same.
Okay, so one thing that I was wondering about, so a lot of times I have traders say to me about their stop loss, and when they take a price action trade, they're looking for a rejection at the top or something like that, and they don't get it, and they never get into the trade because they're looking for that perfect price action entry that they don't get because the market doesn't give it to them. So what do you say about that?
There's at every given second, I remember 30 years ago, 35 years ago, people would be talking about patterns, and you'd always see perfect patterns. But then when I would look at the charts, I never see the perfect patterns, you know, and I concluded that perfect patterns are rare. And so that means if you're waiting for a perfect pattern, you're never going to take a trade. So, but you have to have some way to get into a trade. And here's a simple way, right? If the market is mostly above the moving average and you see a bull bar closing near its high, especially if you see 2 or 3 consecutive bull bars closing near their highs, you just buy the market. So as soon as that bar closes, buy the market. If you want to trade with a stop entry, you place a stop 1 pip above the high of that bar and you buy there. And you keep doing it until it doesn't work, right? So if you're missing a trade, sometimes trades look like this. Here we have a bull channel.
Yeah.
The pullbacks are small pullback. A lot of reversal bars, but the pullbacks are all small. So this is a small pullback bull trend. And guess what? This is a daily chart. What do you think this looks like on a weekly chart? It's a bull bar, a bull bar, a bull bar. You don't see these bear bars, right? So if I see the market having 1 bar pullbacks, 2 bull pullbacks, and the pullbacks are small, even if there are bear reversal bars, there's no way I'm going to short. I'm only looking to buy. So if I see a bear bar, it's going to trap a lot of weak bulls out and weak bears in, but I'm not going to do that. I'm going to wait for the bear bar, and then I'll look for a bull bar after the bear bar, and then buy on a stop above the high of the bull bar. So it's really easy to miss a trade, a trend that can go on a long way. But the easiest way to do it is, if you're not in the trade, you just enter on the close of a bull bar closing near its high, or on a stop above a bull bar closing near its high. So if you buy this close, your stop might be here, the bottom of the most recent leg up. You might use a wider stop down here, so you know how much you have to risk, and you just trade an appropriate size. And as a general rule, whatever you think the appropriate size is, it's probably better to trade half that size, because you'll discover too much of the time that you're thinking about money and not thinking about managing the trade.
Right.
And if you're thinking about money, you're going to lose money. You have to be thinking about, are the things that I'm doing sensible? Am I in a comfort zone? When you trade, everybody is trading to make money, but it's more than making money. You have to be trading for money and for happiness. So you have to be able to trade in a way that's sustainable. You have to be able to trade, you have to feel good every day. You have to feel happy. I remember 30 years ago when I started out, I used to be just ripped to pieces. I'd lose money the next day, lose money the next day. And I was just so upset all the time. And it was horrible. And you can't live like that. You have to find a style of trading. Like you say, you like to trade the daily charts. You got to find a style of trading that's compatible with your personality.
Right.
And I like 5-minute charts. For me, I like to be active. I like to get in. I like to get out, and I'm happy every day. I come to work. I expect to make money every day, and I expect to have fun every day, and nothing. I never get upset. I mean, absolutely zero. Never get upset, no matter what the market does. And I'll say, "Oh my gosh, it's doing that. I thought it was going to do the opposite." I say, "Oh, look at that. It hasn't done that pattern in a while." I just look back and admire it. Also, one other thing, if ever you look at the chart and you say, it's going up, it has to go up, right? The more certain you are that you are right, the less likely it is that you are right. Because the more obvious something is, the more the trade is crowded. So if something is very, very obvious, then everybody is already in that trade. And the trade can, let's say it's a long, right? Let's say you're long. If everybody's already long and you want the market to go higher, you need new buyers. But if everybody who wants to buy has already bought, right? As bullish as you might think it is, this is what can happen, right? So bullish, 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 bullish. Oh, not bullish. Oh my gosh, right? So crowded trades, no matter how confident you are that you're right and you think the market is going your way, the more confident you are, the more likely the trade is crowded, and the lower the percentage chance that you're right is. So the more confident you are, probably the more likely you're going to be wrong.
Right. I see what you're saying. So I'm going to ask you one question, then maybe we could look at a couple from folks and then get you out of here, Al. But one thing, you were talking about a disappointment bar. So when you see, suppose I'm getting into my trade and I don't get a disappointment bar, but I get, what would you call the, like say you get in dojis or indecision bars where are candles with wicks on them right at your entry point. You don't look at that as a disappointment bar, do you?
It depends on what my goal is. If I'm taking a trade for a scalp, I'm planning to hold it for 1 or 2 bars, and I get disappointed, I'm much faster to get out. If I'm buying at a bottom and it's not clear if this is the bottom or that's the bottom, I'm more willing to use a wide stop and be very patient. Okay. So for example, if I buy this and then I see that or that, but I'm thinking that it's a head and shoulders bottom, left shoulder head, right shoulder, and we're trying to reverse up strongly here. I think we'll probably come up here. So if I buy that, I'm not going to get out. If I see this, I'll put a stop maybe below that or below this, and I'll just patiently wait, assuming, because I believe eventually everyone is going to see what I saw over here, and the market will go up. So
the location is a big thing with that, right?
Context. Context means the bars to the left, right?
Okay.
Just because you see a bear reversal bar like this does not mean you should go short. If it's a bear reversal bar in a small pullback bull trend, you don't want to go short. But if you have a bull reversal bar and it's 2 legs down after a pretty strong minor reversal, another strong minor reversal, you're probably going to soon get a major reversal. So this bull bar is much more important for the bulls than this bear bar is for the bears. So you can't just look at one bar. You have to look at the left, the bars to the left, the context where the bar is occurring.
Right. Okay, so let's see if we have just a few questions from someone here and then we'll get out of here. So somebody's asking about, do you even take notice of Fibonacci retracements? Do you use those at all?
I used to pay a lot of attention to Fibonacci retracements and Elliott wave back in the 80s. And there are so many different Fibonacci retracement numbers, so many different levels, and there's so many points to base them on that there's a Fibonacci level at every place on the chart. So I don't pay any attention to Fibonacci retracements. The only retracement that I pay attention to is 50%. And when I'm thinking about a chart, I'm thinking about drawing things with a big fat crayon and not a Sharpie, right?
Yeah.
So to me, if I see this, I say, oh, that's a 50% retracement. And someone else might look at it and say, no, that's a 62% retracement, you idiot. Okay, it's about 50%,
Right.
So, and this is a 50% retracement of that sell-off. Al, it's really 62% or 38%. I don't care. It's about 50%. So I'm looking at about 50% retracements. And sometimes it's more, sometimes it's less. And I think anyone who focuses too much, especially on Fibonacci's, you're missing the big picture. Look at the bars, look at the patterns, and forget about precise Fibonacci retracements. Just look at ballparks. Market's trying to go up. Oh, we went to a new low. Doesn't matter. This is a really strong rally. They'll probably buy again, right? So I don't care if this is a Fibonacci extension of that. I don't care. I see what the market's trying to do. It's trying to go up. It's trying to go up. It's probably going to go up. So, and I don't care that this is not exactly 50%. It's a pullback retracing about half. That's all I care about. So, I worry about people getting distracted. Everybody's looking for a God. This God will protect me. Fibonacci God will protect me, or the stochastics God will protect me. Nobody's going to protect you. You eat what you kill. And if you're trying to find some indicator to tell you what to do, I think it's really hard to get profitable that way. I think it's better just to look at the price action, look at what the bars are doing. Look at the left. What's the market's trying to do? It's trying to go up. Try to go down hard here and reverse up. The market's trying to go up. So, and if the market's trying to go up, I want to buy.
I'm in agreement with you. I believe the same thing pretty much. I like looking at that price action, but I love the way you trade. I love your concepts and your theories, the way you're looking at the markets. I mean, you're a gem because, you've been doing this for over 30 something years. And the knowledge you just gave us today, I sat there the first half hour and I was like, daggone, that's something serious. I didn't really think about that or know that. So I really appreciate you coming here with us today and being with us. So I just want to say thank you very much.
Yeah, I appreciate it. Thanks for the opportunity, Carl. I hope the listeners found it useful.
I hope I get to have you on here again, and I hope everyone enjoyed. So Al, once again, I appreciate you. Thank you very much. And I'm going to end it for now. But until next time, guys, have a great one. God bless.
Okay. Thank you, Carl.
So long, Al. Thank you.
Bye-bye.